Earlier this year, we went into very unpredictable volatility. No one knew. Every day we were like, okay, is there going to be new tariffs dropped on a firm? Are they going to be lifted? And the markets are going up and down.
All right, joining me will be Ben Fulton, CEO of Webb's Investments, who is building out an interesting lineup of what they call Defined Volatility ETFs. So there are currently 13 ETFs in all, two of which are broad-based ETFs where the underlying exposure is the S&P 500 and the NASDAQ 100. And then in July, they rolled out a suite of sector-based products where the underlying exposure is actually select sector spider ETFs. And we'll obviously get into this, but the bottom line is Ben believes investors shouldn't have to choose between managing risk and pursuing growth. He actually says you can have your cake and eat it too, and you can do that with these defined volatility strategies. So we'll go in depth on how these work and how to think about them in the context of a broader portfolio. And I should note, Ben is a longtime industry veteran. This is someone who helped grow PowerShares into a leading ETF issuer starting back in 2005. He was a founding partner of Claymore Securities back in the day, which I think that place has more illustrious ETF alumni than just about anyone. But I could go on with Ben's resume. He is a true ETF pioneer, and he will join me here in just a minute. Now, later, I'll be joined by Arthur Nowak, client portfolio manager at Alger, who's also an interesting ETF issuer. The firm itself has been around since the 1960s. They manage some $30 billion in assets. And I would say they really hang their hat on fundamental research and investing in change. So think disruption that's really driving growth and business expansion. But back in 2021, they got involved with ETFs, and they're now up to 6 ETFs in total, including the Alger AI Enablers and Adopters ETF and the Alger Concentrated Equity ETF. So we will take a look at both of those strategies. And as part of that, I also want to talk current valuations around some of the names involved with artificial intelligence. I know investors have some concerns there, so we'll touch on that. And then we'll spend a few minutes discussing how best to sort through the growing number of active ETFs out there, which I feel like is becoming a bigger challenge every day. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. All right, let me now welcome in Ben Fulton, CEO of Webb's Investments. Ben, it is so great to reconnect. It's been a while, so thank you for joining me.
Nate, thank you, and thanks for the invite. And love your podcast and love the ambassador you are to ETFs.
Well, thank you. The feeling is mutual for sure, given your background in the industry, Ben. But, you know, it's funny, and I hope you don't mind me sharing this background, but I was actually on another podcast when the topic of your defined volatility sector ETFs came up. And I thought I did a pretty good job of explaining these, but I clearly missed some nuance here. And I know that because you and your team reached out and politely offered to help better educate me on these ETFs. And I said, you know what? Why don't we all learn together, right? I can learn right alongside the ETF Prime audience. And so I do appreciate you coming on. And let's just dive right in on these sector ETFs. I know you have some other broader products as well, which we can certainly touch on later. But let's first talk about these sector ETFs, which back in July, you launched this lineup of 11 defined volatility sector products, where the underlying exposure, as I noted, is actually select sector spider ETFs. So for example, there's the Webb's Defined Volatility XLK ETF, ticker DVXK, where the underlying exposure is the Technology Select Sector Spider ETF, ticker XLK. I am just going to let you take it from here so I don't butcher anything. Explain for us the strategy here.
Yeah, no, it was something that after I left PowerShares, a few years after that, I actually went to work for one of the large levered and inverse shops, and I was a little shocked when I got there to realize how many people were long-term holders of 2x or 3x funds. as investors. And I went, you know what, that that works until it doesn't work, and the downside is so terrible and can be harmful to the investor's portfolio that we started thinking through this. So myself and two of my partners at Webs came out of that shop, and we started for 2 or 3 years really analyzing, looking at the marketplace. And one of our theses at the beginning was that maybe there's enough ETFs in the market. Not saying there's not some new innovation, AI or something different that wasn't around, but there's a lot of great products out there. But is there a different way for investors to experience or be part of that? And so something we started looking at, and then one of our second thesis was we knew that when, and let me ask you this, Nate, do you agree that when volatility in the markets are low, markets tend to outperform compared to when volatility is high, they tend to underperform?
I would say intuitively that certainly makes sense.
Well, and analytically, we proved it out. I mean, you can see it; it's huge. Almost all the returns of the market come when the volatility of the market is below the historic volatility level. So when you go into kind of a safe environment, markets tend to outperform. So we started going: is there a way to benefit from enhanced exposure when the risk is off, but exit or reduce exposure when risk becomes elevated? And there's times where you can have high vol and the market goes up, but frankly I'll give those up for the safety of knowing, at those times we need to reduce our volatility and step out. So that was really the beginning of what became defined vol. From there we started looking and saying, so where are investors investing? For sure, our first two products were on the S&P and the Qs. I've always been a sector junkie because I think, back in the 90s when I started building first products, there was a lot of a talk then that sector selection was probably more important than the fundamentals of the company. If you get the sector right, that's probably going to be 80% of the move of the stock. So you get your sector selection right and then try to figure out the best stock within that sector. Or in along came ETFs. Now you could just sit there and say, hey, I can buy XLK or I could buy XLE if I feel energy's underexposed. So that was our second round of products. Now, little different than our first ones. We took a little more aggressive stance on the sectors because we think those are high conviction trades. People are looking for a higher, they want to be rewarded. If I make that allocation, I want to see that if I called it right, I'm going to get the benefits of that. So we tended to go out with a little more of an aggressive stance. So instead of being at historic volatility levels, our target, we're at about 120% of historic volatility levels. So it also allows it to be move a little quicker than our original flagship products.
So, again, if we just boil this down, because I want to make sure everybody understands how these products work, explain at a high level what's actually happening underneath the hood.
Yeah. So what we do is we measure any ETF or index that's out there that we want to build a product on, and we define what that long term volatility level was. So and this is realized volatility level. So for the sectors or for SPY or whatever, we did approximately a 20 plus year look back. So what's the historic norm there, and then we daily look at what is the last month's volatility in comparison. If it's below, let's just say our goal was 20 and the market says, hey, today we're at a 10, we could be up to a 2x product. If the market says, nope, we're at 20 and it's 20, we're a 1x product. We're XLK, XLE. But if it's at 40 vol, all of a sudden we're a 0.5 exposure because all we do is it's a ratio. We look and say, tell us what the short term is compared to the long term and adjust accordingly. And every day we go through this mechanical thing. And using the ETF wrapper, it puts it in the most tax friendly environment to do this. So it's not hard, but it's novel because only institutional clients have had the ability to access this in the past. And we put it now into an ETF, and we're saying you don't need to redo your analysis, but maybe you need to own your ETFs in a way that, like I like to say, is better suspension and hopefully better horsepower. So we're gonna help your ETFs along, and you make an allocation. And but we're in time we would like to have additional ETFs be part of it, but also maybe a conservative, maybe an aggressive, different stances so people can pick their risk tolerance.
So if I just restate the strategy very simply, when volatility is low, in this case on the underlying sector, you will start ratcheting up exposure to that sector spider all the way up to potentially 2x. And when volatility is high, you'll start reducing exposure. How low can that exposure go? All the way to zero?
Well, in theory, you could, but in reality, that we'd have bigger problems. That means the market's dead, so we're probably not real worried about what's happening. But like if you see like great financial crisis, I think we got down to on the broad based about 20% exposure. Earlier this year, right when all the tariff chaos started going, we were down to 40% exposure at that point. And then, when the calm started coming in, you have to kind of work your way through that process. But then we started increasing, and now we have some sectors and the market are, uh, 150 to 200 range, a lot of them, because the markets have been calmed down and we're seeing it play out in the performance of the market. But if volatility returns, it'll start dropping pretty quick.
I want to have you emphasize a point you were making earlier just regarding conviction in a particular sector. And if I recall correctly, I think what you took issue with in my comments on that other podcast was that I raised the question of, like, why would an investor want guardrails around a sector ETF? That's what I called your approach, right? Investing with guardrails. And I said, if someone is investing directly in a sector, they likely do have higher conviction because somebody's not going to target, say, utilities. Maybe utilities is a bad example, but they're not going to target utilities unless they think that sector is going to outperform. And so I said, why would they want to lower exposure if volatility spikes and things aren't going well at the moment? Because that doesn't scream high conviction to me. Your response was that, well, actually, these are exactly the products that high conviction investors should be looking at. So I just want to home in on that. Talk more about that. It actually does seem obvious to me now. What can I say? I don't get everything right the first time around, but I know this is a key point here. So elaborate on that.
Yeah, well, Nate, and it's interesting. Uh, no one's ever going to question your wisdom, and I'll just say the hardest thing with these products is it's something that's never been seen before. Although um, it's not hard to understand once you hit it, but you have to kind of break out of the world of a 1x world. All of a sudden, it's like, wait a minute, what if I'm not limited to my exposure, but I picked the right sector? What's happening? The interesting thing, and we're working with, we'll have some models coming out utilizing our sectors. With the first ones will be with groups like Dorsey Wright and others that are their technical analysis tends to work really well because they tend to be momentum driven and they pick up the momentum, but the momentum doesn't trigger typically unless you're in a low volatility state, which is kind of our perfect environment. So, is it the chicken or the egg? I don't know. It doesn't really matter. We have chickens and eggs, and I'm just saying it provides the opportunity. And when people start doing these allocations, especially if they are looking for have a momentum tilt, our product's very momentum oriented, and you tend to really, what we like to say is we lean into a favorable markets, we lean out of unfavorable markets, or risk on, risk off trade. A lot of times we'll hear about in the market. These are kind of automated, built that way, and yet wrapped in a tax friendly environment. So, if a person tried to do this on their own, both to access the leverage would be expensive, but more importantly, the taxability would be detrimental to most. And, we're just putting in an easy wrapper and it's there. But I think what always hit me is, and a lot of times we're lumped together with outcome based. It's because we all came about at the same timing, we'll say. But I always say outcome based, nothing wrong, great product, but they're more like airbags in your car. This is the selling feature is we will save your life in the middle of a wreck, and they do a great job of that. We're not going for that. There's ways to create safety in your portfolio. We're saying, hey, let's improve your suspension and let's up your horsepower. And you can actually enjoy what you drive already and be able to stay on the road and keep doing what you do. And so I think we actually complement the outcome based, but we're totally different. We're not guardrails. In some ways, if a person looked right now and say, "Oh, you're going for safety," well, if our sector's at 2x right now, you know, was it a week ago when the market fell down today? We had a rough day that day, but we are built for holding it over time. Sectors, it doesn't have to be as long as the broad base, but the reward comes in, somewhat we'll call a little more buy and hold, or for sectors at least 1 month, 2 month, 3 month type time horizons. But it shows up. I mean, we've got some pretty astounding returns month in, month out on things like XLC and XLK and others because we're getting the benefit of not being stuck in a 1x world. So
Yeah, and on that note, I mean, it sounds like from a portfolio application standpoint, and maybe this is obvious, you see multiple use cases for these ETFs. It could be longer term buy and hold investors, as I mentioned at the top, who they want to have their cake and eat it too, right? They want to manage risk, they want to be able to pursue growth. But it also sounds like, particularly on the sector products, maybe you have some more tactical investors there. Is that fair? Are there any other use cases?
that's very fair. We are working to get options out on the products. We think there's some interesting things that can happen in the options. I actually think we could, and we're talking with some of the outcome based firms. We actually think we can build them a better outcome based product than what they've had because our caps are a little more potentially higher, and yet we have a controlled volatility. So the options exposure should be more flatlined, and so I think there's some really interesting case use theories that can go out there, and we're still exploring that. And some people we know that are they're working on taking one of our flagships like the one SPY and then going heavy some sectors. So let's say 75% DVSP, which is our defined vol SPY, and then adding 3 or 4 sectors that they want to be overweight. And I think those are interesting. I always say the best products are both A, simple to understand, but B, you really don't understand when you build them and you watch it bloom and flourish over time. You're like, oh, that's a good idea. I never thought about that. Oh, okay. So we like the conversation. We like the dialogue. We're very advisor investor focused. At the end of the day, we're trying to solve a problem, and the problem being either A, if you're holding just a straight 2x product, you have more risk than but also the markets are volatile. And when you look at the volatility curve, that's usually like when we sit down with an investor, we start with, here's the natural volatility of the S&P 500. People go, oh my gosh. And does that make you feel queasy in times when it's going up and down and you know what's happening? What if we could control that, put it at one level, and then here's some of the additional benefits that come with that, which hopefully is rewarding and helps the investor just understand this thing. I think it's very much like barometric pressure. You can see the rain in your background. You were talking earlier that I'm sitting there going, yeah, you know what? If you ignore the barometric pressure, you don't go with an umbrella when the barometer is changing, you're missing. Well, the same thing. Volatility is one that, as an advisor, what am I going to do about it? And what if bonds and equities, like we've seen in the last few years, becomes highly correlated? Well, you need to allocate or diversify your risk, and we're giving a different way for you to do that within the walls of an equity portfolio. We're very equity-esque focused, and I think that's the other thing that's unique is a lot of the products have been built, I would say, are probably more fixed income, potentially replacement type products. Ours is very much like at this point, we could use it on fixed income, but we've been very equity, but we may do some alternatives. We're talking with some groups about some of the product. We're partnering with ETF firms. That's the other thing that's unique. We're going to them because we actually buy their product. And then if we utilize, the derivative we use to get the exposure, it actually drives assets. So we're actually a partner with the ETF industry. We're not a We like to say we're not competing. We're just giving you a different way of owning their products. So
Let me ask you this, and this won't surprise you at all. I think you know me well enough to know that I always try to look at the pros and cons of any ETF or investment approach. And I think you've done a great job of highlighting the benefits here. In thinking about volatility, and as I was looking at these ETFs and trying to think of potential downsides to the strategy, it seems to me like the biggest downside would be rapidly moving markets, where let's say there's initially low volatility, and so the strategy is full pedal to the metal, and then there happens to be some sort of massive quick downturn, or vice versa, right? There's initially high short term volatility, and so the ETF's exposure is lower, and then for whatever reason, the underlying market spikes and you're sort of caught off sides. Is that the best way to think about what could go wrong here?
yeah, I think you nailed it. I mean, earlier this year, we went into very unpredictable volatility. No one knew. Every day we were like, okay, is there going to be new tariffs dropped on a firm? Are they going to be lifted? And the markets are going up and down. And so that was registering volatility noise. So we were underexposed, but if the market took off, we weren't moving with it because we had 40% exposure. The hardest market, I will say, is a grinding down market like we saw post the bubble in the early 2000s. And it grinds down, and yet volatility is low. So we may have enhanced exposure, and yet the market's just grinding down lower. Now, we don't see those very often, thankfully, but if we would have had this on in Europe during ETH, I always say we can't make an ugly index pretty. If the index has to be doing well, and we can help it, maybe even along. But if it's underperforming, flatline, or just grinding away, those are tough to do. But if I decide I want to own EFA, or I want to, I you know, Europe's having its problems this week, but if all of a sudden I wanted a Europe product, I would still, if I decided it's the right time to buy, I would rather own a defined, if we had that, a defined volatility version of it. But the first thing is you got to make the decision: do you actually want the exposure, and is that a good trade? Is that a good opportunity? If it is, then we think we're providing is maybe something to consider, and may even be a better option for you than just owning the straight up 1x product. So you got to make the right decision first. The hardest one, though, is like you laid out, Nate. And time doesn't. If you've held it long enough, we like to say our broad based, our flagship, you should have at least an 18-month time horizon. At 3 years, and we can put this together and we can walk you through it. But we've got about a 99% confidence that we're going to outperform at 3 year rolling period. So, it works the longer you hold. If you said, I need to do this because my son or daughter set out of school this month, and they're going to enter college in January, I need that money, don't use our product. In fact, I would argue don't use any, put it in cash, make sure it's there. But if it's got a longer term horizon, this is a great option. But our sectors are a little more aggressive, as I said. They can be a little shorter, but you still, you got to realize we're not necessarily we're identifying risk, we're not changing risk. Just like barometers identifying change of weather, but I can't change the weather. I just need to be prepared for what it's doing, and let's help address it. So
Yeah, I think the point here, and it's not surprising with how these products are constructed, you may have some shorter term, let's call it tracking error from the underlying index, depending upon what's going on in the markets. But it sounds like, and I want to be careful here, I don't want to get you in any sort of compliance hot water. So I'll let you handle this however you want. If you want to, you've already somewhat alluded to back tested performance, but I'll let you decide how you want to handle this question. It sounds like if you look over longer periods of time, investors really aren't necessarily giving something up in the way of returns with your strategies for that smoother ride overall. Is that
yeah,
fair?
if it's an advisor and you go to our webpage and you enter that you're a financial professional, all of our products we've actually partnered with an index firm, Syntax, and Syntax has that data, and we have that data available to financial professionals. Investors, it's a little different, but there is a Syntax website. You got to go through the custom indice area, and you can find why we're excited about these products, and that's publicly available information. But we studied this a long time, looked at it. No guarantees out there, but I think it intuitively, like you said, once you think about it, you start going, intuitively it makes sense. Sectors are all over the place. I mean, we have days, I have my screen set up almost like a heat map, and some are green, and some are red, based on what's going on. And you're like, yeah, because that's what happens in the world of sectors. But that's also why I like sectors, is that it kind of tells you the rhythm, what's happened in the market, instead of being cloaked by a broad base that you don't really know what's driving. But yeah, we're excited about it, and it's for sure. Advisors, we encourage you to reach out to us if you have some other thoughts and ideas. I don't know if you've dealt with we're also talking to some groups as we look at future products. It's kind of a perfect product for 351 type exchange. If someone had existing, maybe a client that's held it for a long period of time and wants to have a lower volatility target, we'd be very interested in working with some groups on that. So any of those type of things, we encourage the conversation. But we're explorers. At the end of the day, I was kind of almost semi-retired and was thinking I would just build this on license. And we found a great partner in a firm called Westwood, who's looking to enter the space. And they said, hey, we could partner in. Why don't you launch these products? Let's work together on it. And I looked and said, you know what? We could do this. And so I have a heavyweight team of ETF veterans that are with me. We've been around. We've built a lot of different products. My COO ran the whole Deutsche Bank commodity business and started an ETF business and built that out. So we have the capability to know how, and it's fun being out there talking to the advisors. I mean, I started as an advisor prior to the '87 crash, and I look and go, a product like this, because living through that, and that was one of the ones I kept thinking about. August started seeing volatility spikes in '87, and if you take it back then, this product would have prevented. But then when capitulation happened, all volatility got out of the market, and you go, that's when you went down. A V type of return. It was going to take a little bit of time to work itself out, but once it did, you had blue skies. So why not? So,
well, Ben, you have always been an ETF explorer, so that's nothing new.
Sometimes people go, "Oh, you think out of the box." And I said, "No, my problem is sometimes I can't find the box, but we try to keep it back, bring it back, and But at the end of the day, if there wasn't, the question I always go was, what's keeping the advisor up at night? And if I can help solve that riddle, that's great. That's why we created the first factor in low vol products years ago. And I think I've always been on this track of how do we help volatility? And I think this is the closest we've come to an answer that both, hopefully protects or gives I hate to use the word smoother ride, more a consistent ride, but still maintains the upside. I think we've hit on something here, and we'll keep working. So that's good.
Well, Ben, excellent discussion this week. I certainly appreciate you coming on here and educating everybody, including myself. So thank you for that. Thank you for taking the time.
Nate, you're loved out there, so don't worry. Thanks for picking up the phone, and allowing the conversation to happen. But debate's good, that's the fun thing. So
that was Ben Fulton, CEO of Webb's Investments.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with Verify and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between Verify, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
At Lazard Asset Management, we look beyond what the world sees today to help our clients achieve their unique financial goals. Our powerful suite of active ETFs reflects decades of experience from our specialized investment teams and a commitment to delivering results. Experience the power of active investing with Lazard. Visit lazardassetmanagement.com to learn more. The Lazard ETFs are distributed by Foresight Fund Services, LLC.
I'm now joined by Arthur Nowak, Client Portfolio Manager at Alger, who currently offers 6 ETFs, about $450 million in assets, though the firm overall manages some $30 billion in assets. That's across mutual funds, SMAs, collective investment trusts, etc. But on the ETF side, they're continuing to grow and expand that business. And Arthur is joining me from New York. Arthur, welcome to the podcast. Great having you on here.
Yeah, thank you so much for having me on. I'm excited to talk to you today.
All right, so it's interesting. Alger has been around for decades, going back to the 1960s, I believe. And you've actually been involved with ETFs for going on 5 years now. Alger launched its first ETF in early 2021. So you are not new to the space, but my sense is not everyone is necessarily familiar with the firm. And so I thought, let's start there. Tell us more about the firm overall for people unfamiliar with Alger.
Yeah, sure. Thank you so much for asking. So Alger is a privately run investment boutique. Like you said, we actually just celebrated our 60th anniversary last year. The firm was started in 1964 by Fred Alger. And I think one thing that makes us a little unique is that, we're pretty focused on one thing and one thing only, and that's growth investing. We don't have any value funds. We don't have any fixed income funds. We have one blend fund, but I would say 99% of our firm's assets fall into to growth. And we have a singular focus on bottom-up fundamental research, particularly through active management. On the ETF side, as you said, we started launching ETFs in 2021. I think we did a good amount of research on kind of where flows were going and the benefits of ETFs, and realized that the space was kind of going in that direction. And we just launched one earlier this year. We launched 2 last year, and 3 have been going since around 2021.
Yeah, and with the ETF lineup specifically, and we'll certainly get into several of these in more detail, but as I look across the 6 ETFs, 5 are actively managed. And as you were just touching on, Alger does have a very strong reputation here. I'd love to have you talk more about that, just in terms of the firm's capabilities on the active side and sort of how you view the investment world overall. You mentioned the growth focus, but just talk more about the firm's overarching investment philosophy.
Yeah, look, I mean, I think there's a lot of growth managers out there. I think what makes Alger a little different is that is the companies that we're looking to invest in. We invest in what we call positive dynamic change. And half of that equation are your typical growth companies, high unit volume growth companies like Microsoft or NVIDIA. But what I think makes Alger unique is that we're also looking for companies that we define as positive life cycle change companies. And those are companies that are benefiting from a change in management, introduction of a new product, or new regulations. I would say think Meta a few years back. Our Fred Alger, our founder, when he met with analysts and they pitched a name to him and they went through balance sheets and income statements and spent 2 hours on calculations, he would always end the meeting by saying, "Great, where is the change?" I think that Alger was really built for periods where there's a lot of disruption and a lot of innovation going around. And I do think we're living through one of those periods now, whether you want to talk about AI, robotics, autonomous driving. I think our performance has shown over the last couple of years that we're really built for these times. And in terms of capabilities, each of our portfolio managers has their own analyst teams. They also have access to a centralized pool of 22 analysts. And like I said before, we have a deep commitment to fundamental bottom-up research. Most, if not all, one strategy that we have that we might touch on later is factor-based, but everything else is really active. Nothing's following a benchmark.
All right, so that sets the perfect backdrop here because I do want to look at a few of the Alger ETFs. And I'll tell you, Arthur, the first one that jumped out to me, you were talking about change, and you think about artificial intelligence right now and how that continues to be such a big story. You offer the Alger AI Enablers and Adopter ETF, ticker ALAI. This is a fairly concentrated portfolio of companies developing AI technology or integrating AI into their businesses to make them more productive. So it is sort of a two-pronged approach, which I think is unique. But talk more about this.
Yeah, sure. I mean, I think before I talk about the actual product, I do think that we feel like AI will be a decades-long investment theme. If we're talking about a baseball game, I don't even think we're out of the dugout yet in terms of what it's going to mean for the overall economy. I do think it's going to touch every sector of the economy, mainly on the adopter side, which we'll touch on in a second. But I do think that the pace of innovation is getting faster and faster. Winners and losers are emerging on a day-to-day basis. And I think it's really important to kind of have an active manager when investing in a theme like this to kind of be pulling the levers. So on the actual ETF, AI, I want to talk about two quick things. One, our investment team, and then two, our kind of philosophy and process. So on the investment team side, Patrick Kelly, who's a portfolio manager on the product, he was actually our head tech analyst before becoming portfolio manager in 2004. He's been at Alger over 26 years now. And actually, his co-PM on our retail mutual fund side, Dr. Ankur Crawford, she actually has a PhD in material sciences and engineering from Stanford, and she actually holds patents in the semiconductor space. So I think both Patrick and Ankur are very innovative, very forward thinkers. Just an example, everybody started talking about AI in 2022 when ChatGPT came out, and it's kind of been a buzzword ever since. Patrick Kelly put out his first white paper on AI in 2017. So, this is a subject that we've been studying for well over a decade. And we think we've developed a team of both analysts and portfolio managers that can really excel during periods of high innovation and take advantage of what we think is going to be a decades-long thing. In terms of the investment approach, and you pointed this out before, I think our approach really distinguishes us from a lot of the competitors out there. As you mentioned, we invest in both the enablers and the adopters of ETF. And I think that's what makes this product unique in kind of the AI space. I think a lot of the competitors are somewhat myopic, maybe focusing only on semiconductors or only on robotics. We're looking at AI more holistically, not only investing in those enablers, so your hyperscalers like Microsoft and Amazon and chip makers of NVIDIA, those companies that are building out the AI infrastructure. But we're also investing in companies that are adopting AI into their business model to either become more efficient or build a better product. I think two good examples of adopters are going to be your Netflix or AppLovin. They're not building their own large language models. They're taking AI into their business models to become better companies. And I think the performance has kind of spoken out to it. Similar to other Alger products, there's no screening or factor-based or benchmark following here. It's completely active. Names are picked by portfolio manager Pat Kelly. So again, I do think it's a teams as well as our approach to investing in AI that really makes us different. And the process has already yielded results. ALAI, since its inception early last year, is actually in the third percentile in its Morningstar category. It's up almost 78%. It's outperforming the S&P 500 by about 50%. Over that time period. So we've seen good results so far.
One question I have here, clearly, as you describe all of that and you talk about the portfolio management team, there's no question Alger is highly optimistic on the future of artificial intelligence. And I would say, I think most investors get the AI story in the sense that they understand how transformational this is going to be. I think that's pretty evident. The question that comes up, though, Arthur, is on valuations. Like, is this all already priced in? Especially if you look at some of the largest names that are benefiting from AI, the NVIDIAs and the Microsofts and so forth. So I'm curious, how are you thinking about valuations right now?
Yeah, sure. I mean, I think that's a very valid point, and I get these questions on valuations all the time. It's certainly higher. At least the S&P is by a good amount over its 10, 15, 20-year average. A few things on it. I really do think it's on a case-by-case basis. And again, I think that's why active management is so important. For every stock that we invest in, our analysts build out at least 3 years of earnings for all the names we hold. So yeah, I mean, some of the Mag 7 that we talk about every day might look expensive on a next 12 months basis, PE. But some of them really still look very attractive when looking through to 2026 or 2027. Some of them are trading 13 or 14, 15 times. And I think, especially if you look at a name like NVIDIA, these names have shown through earnings that they continue to execute on their business plans. And then, we always say that what drives stock prices are the underlying earnings. And so we feel at Alger that we can create alpha by significantly overweighting or significantly underweighting these names based on portfolio manager conviction. The second point I would make is that I think that companies, the biggest companies in the world nowadays look very different than they did even 10, 20 years ago. I think if you look back maybe a decade or 2 decades, the biggest companies in the world were Ford to Walmart's. And those are kind of companies that were very tangible asset heavy. So buildings, supply lines. If you look at the largest companies now, companies like Microsoft and Amazon, they're much more weighted towards intangible assets. So the issue here is that traditional accounting standards haven't really kept up with this shift from tangible to intangible. And these standards treat intangible investments very differently from tangible assets. So physical assets like factories equipment are capitalized and depreciated over time, which allows their costs to be spread across years and where they actually contribute value. Companies like Microsoft and Amazon, who have a lot of intangible assets, by contrast, are typically expensing them immediately under GAAP. So this means that in the year that you actually use intangible assets, it more significantly reduces current earnings. Long story short, I do think it's on a case-by-case basis. And maybe valuations look expensive on a historical basis, but we do think that companies look very different now than they did in the past, and that there's opportunities out there.
One other quick question I have on ALAI, and you were talking about some of these mega cap companies here. As I was looking at the holdings in the ETF, there are a lot of the biggest names. You have the NVIDIAs, Microsoft, Amazon, Meta. So do you view this ETF as a core holding that would replace, say, someone's S&P 500 exposure or something similar? Or where does this ETF fit in a portfolio?
Yeah, sure. In terms of holding kind of NVIDIA, Microsoft, Amazon, I think you kind of have to, just because that's where, a lot of the returns have been over the past couple of years. Those are the companies that are actually building out the infrastructure for AI. I do think that the portfolio will shift and change as it goes throughout the entire economy and becomes more about adopters and less about enablers. But But considering how important we feel that the AI investment theme will be, I think this could be considered a core growth holding. We do feel that everyone should have some access to an investment that's making direct investments in AI. It depends on whether or not you want to use it as core or a kind of specialty satellite holding. But we do think it could be considered a core growth holding at least.
All right, another ETF I wanted to ask you about, just because I think it is so reflective of the Alger approach, is the Alger Concentrated Equity ETF, ticker symbol CNEQ. So this targets 30 or fewer companies demonstrating promising growth potential. So the way I look at this, these are the highest conviction ideas. So tell us more about this ETF.
Yeah, for CNEQ, that is born out of our large cap growth suite of products. So Focus Equity, Capital Appreciation Spectra. Focus Equities is managed by people I already mentioned, Pat Kelly and Dr. Anka Crawford. It was named to IBD's Fund of the Decade. It was on Wall Street Journal's Winner Circle last year. Top five percentile over the last 1, 3, 5, and 10 years. So we wanted to give investors access to this research and performance in an ETF format. And so that's how we came up with CNEQ. It's run by Dr. Anka Crawford again. It's a 30 stock portfolio. It's more concentrated. It's more focused version of the firm's kind of large cap offerings that we already have out there. And it allows Anka to kind of take larger positions when her conviction is high in names. So again, less names, bigger position size. So it's non-diversified. And so we look for companies that are driving change and driving us forward into the next decade. Similar to ALAI, the early returns have been fantastic on this. Since its inception, it's up about 66% versus the Russell 1000 growth up about 38%. So about 2,800 basis points of outperformance there. Good for second percentile in the category. And again, it's really just a more concentrated, more focused version of what we already have out there in the world, what Alger is kind of known for, which is growth equities.
In terms of the holdings themselves, as I understand it, this is large cap focused, but it can go down the cap spectrum as well, correct?
Yeah, absolutely. I mean, it's anchored in large cap, but if we get a good name from one of our mid cap portfolio managers or one of our mid cap analysts, I think we're going to add it to the portfolio. Names that we've held in the past when they were a little smaller were AppLovin and Vertiv. If we think a name is going to translate from a good mid cap company to a great large cap company, we'll hold it in this portfolio.
Arthur, as I was thinking about our conversation, and if we just take a step back here, I'll tell you that I've talked a lot on this podcast about the rise of active ETFs overall, and clearly Alger is leaning into this. I thought you just did a great job of explaining the firm's investment chops here. But with the ETFs, I think from an end investor's perspective, it feels like every day becomes more challenging and trying to wade through the growing number of options out there. And I think about the forthcoming multi-share class structure, which that will likely create another wave of active ETFs coming to market. We continue to see new entrants into the active ETF space overall. Are there any words of wisdom that you might offer to investors who are trying to sort through the options here? It just seems like on the index-based side, if you want exposure to a certain segment of the market, you go find an ETF tracking that index, you look at fees, you look at the basic index rules, and you're likely 90% of the way there. But with active ETFs, it just feels like the due diligence process is more cumbersome and maybe even more important. And so what tips might you offer?
Yeah, I mean, I think that's a great question because to your point, I do think it's only going to become more difficult. You pointed out that in the next coming months or years, we're going to have ETFs as a share class. I think we're going to see more and more fund conversions from mutual funds to ETFs as they kind of scale up. And so options will be boundless, and we think that it's a good and a bad thing. And so I think you need to approach it similar to how you would mutual fund due diligence. I think, if you're just looking to go passive, that's a pretty easy due diligence process. But if you're looking into a mutual fund, you generally talk to the client portfolio managers or the portfolio managers themselves, the salesperson. You should get comfortable with not only the structure of the product, but also the investment team, the philosophy, the process, the fees. I think you should look at past performance. I think you should basically do what you're doing with mutual funds now, but do it to an ETF. And I think due diligence is paramount when choosing the right investments for both yourself as well as on clients. So, again, I think deep kind of dives on all the names you hold and understand what they're holding is important.
Well, and I would say from an ETF issuer perspective, and I think Alger certainly fits the bill here, you want to be differentiated in your strategy, because I can tell you firsthand, just if I put my advisor hat in looking out at the market on the active side, there are a lot of products that all look the same, and it's very difficult to differentiate. So I also think looking at things like active share and what we were talking about, how do these fit into your portfolio? All of those are extremely important. Just a few minutes left here. I mentioned that 5 of your 6 ETFs are actively managed. I have to ask you about the one that is index-based, which is the Alger Russell Innovation ETF, ticker INVN. Do you want to briefly touch on this? And it's funny, as I was looking at this, I mentioned on the previous ETF that it really was representative of the Alger approach. I feel like with this ETF, Alger sort of packaged up its investment philosophy into a rules-based approach. So talk more about that ETF.
Yeah, I'm glad you asked about it. That ETF is actually ran by my boss, Brad Newman, and his co-PM, Greg Adams, who's our head of quant. And I think we do have a unique approach to investing in innovation with INVN. We talked a lot about active management and bottom-up research. But our head of market strategy, Brad, who's my boss, he wanted to see if they could figure out a way to invest in innovation using a factor or rules-based kind of top-down approach. They worked out a number of different factors to try and to design a benchmark. And then we ultimately ended up teaming up with Russell. And what we do is we take the Russell 1000 index, not the growth of the value, the baseline index. We cut out the bottom third of companies with lower free cash flow margin. We don't really want to hold kind of young, risky companies that aren't generating free cash flow. And then we rank the rest of the companies based on R&D as a percentage of enterprise value. And the result of that is the Alger Russell Innovation Index. And I know you've probably heard of GARP, growth at a reasonable price. This product we say is HIP, so HIPP, high innovation, prudently priced. The resulting benchmark has an R&D to sales percentage of 20.3. The baseline Russell 1000 index is at about 9.9. We talked a lot about valuations earlier. This product has a next 12 months PE of 14.5 versus a bench about 22.9. So that's where you get the prudently priced. And we did a lot of work kind of back testing the results with Russell, and the results are kind of staggering on the back test. On average, the index was up about 17.6% per year, versus the Russell only up about 8.2. So over 9% of alpha generated on an annualized basis is pretty staggering and pretty stark. So, that's INVN. Instead of our typical bottom-up fundamental research, It's just investing in innovation using a top-down rules-based approach.
All right, so one index-based ETF, 5 actively managed ETFs. Before I let you go, can you tell us anything about the future roadmap for Alger ETFs? And I'm not expecting you to give us exact ticker symbols and strategies, but what can investors expect from Alger moving forward?
Yeah, I think I'd get into a lot of trouble doing that. I do feel like and I appreciate the question. I do feel like the market has voted with the dollars when it comes to ETFs. I think investors generally lean towards ETFs just because, if you consider an ETF, there's possible tax advantages. They're generally 20 to 30 basis points cheaper than their mutual fund counterparts on the active side. And they also offer daily liquidity, the ability to get in and out of them. So, I believe that any new product offering from Alger in the future will have an ETF arm to it. I think our main goal, and at least in the future, is to be somewhat vehicle agnostic. I think we want to talk to advisors and consultants about Alger, about the portfolios, about the main investment process, about our philosophy, and then give the advisor or consultant the option to choose how they want to invest, whether it be mutual fund, SMA, or ETF. But like I said, I do feel like we're probably leaning more toward ETFs going forward just because of the benefits that they offer.
Well, Arthur, really enjoyed connecting this week. Again, I thought an excellent look at Alger and your ETF lineup. Thank you for joining me.
Yeah, thank you so much for the time. This was a lot of fun. Hopefully we can do it again.
That was Arthur Nowak, Client Portfolio Manager at Alger. That'll do it for this week's ETF Prime. I'm excited to tell you that I will be at Exchange 2026, where I will be taking the stage and even recording a live episode of this podcast. So this is your chance to join me alongside a community of top advisors and industry experts for a few days of world-class content and unparalleled networking. Secure your spot today by visiting exchangeetf.com. Next week, I will be joined by Daniel Noonan, head of the Wealth Management Consulting Group at Cohen & Steer. So this is another big asset manager who just launched their first ETFs earlier this year. So look forward to that conversation. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.